Well, here we are. The election is over. I've got nothing good to bring to you today. We got some lot of warnings. We've got a lot of bad things that are coming our way. Let's get right into it. Let's talk about what's going on and what we can do about it. So let me go to my very first slide. Let's realize that we are always in an economically changing environment, just constantly. So you need to always, as an investor, and just as a regular person trying to get themselves through life, you have to realize that nothing stays the same. It's always changing. And we've got a lot of changes coming at us. Let me go to my very first slide here and let's just talk about what we see. So, everyone's talking about a recession. You know this, that recession is going to kill inflation, and inflation is certainly going to go away. We see it in the data. It's slowing down radically, but probably not quick enough to forestall any rate increases, because I think rate increases is really, there's another agenda. Not only do they want to kill inflation, but I think they want to kill a little business too and really slow things down. So here's what we see. Just got this slide basically today, and we're talking about the PPI. And you can see by what went on, of course, this is very, very scary, but we almost went to 12% at the producer price index. Now that's where it starts. You saw that a lot in food. You know, when you start seeing all the grains come in and you start seeing the grain prices go up, well, everybody's got to produce those. So the manufacturers start adding in costs. And that gets to be a fairly significant cost, because if it's at 12% at the PPI, it's going to be a lot higher when it comes to the CPI, which is Consumer Price Index. So we did peak. Looks like we peaked around 11%. And now it's down to right around 8%. Still pretty high, but a 50% reduction. You know, we're going to go down pretty quickly here, but it's going to take 3 or 4 months. So inflation is going to go away. But look what's happening. This is what's happening on. So all this is causing major problems. Now you got a couple things. Interest rates going crazy all across the world. You know, this drives government debt service off the charts. Virtually all the corporations' debt service off the charts, which takes a lot of the discretionary capital away. And of course, we've been watching this, so that the PMI all across the globe is dropping. It's just barely at break even. Now, you know, with PMI, if it's over 50, we're expanding. If it's under 50, we're contracting. We're right at basically 50. I'm assuming that we're going to get a global recession. I would just be absolutely shocked. My personal read on this is that we'll probably have the worst recession we've had in over 50 years. So you need to brace for that and try and protect you and your family. We're going to talk about that just a little further. Look at this. We're starting to see employment and export orders start to drop. So when you see employment, now remember, employment is one of the last leading indicators. Employment generally goes up. It generally holds it through the beginning of the recession, because really when you have employees, you don't want to lay your employees off unless you absolutely positively have to. They're like the last remaining indicator, and that's rolling over now. And we're seeing that in this data. Let me go back to that slide. I want you to see the data. You can look in this data and you can see the fact that we've got new orders, and export orders are declining. So that means that the future business is really dropping off radically. And of course, that's what we do. We're in business to make things. If there's no orders for it, we're starting to come below 50 on these. And that's a very big indicator that the next couple quarters are probably going to be down. I think we probably have 3 or 4 quarters of pretty severe economics here. And of course, into my industry, we just got this reasonably quickly, 2 weeks ago. The pending homes dropped another 10.3%. This is really negative for us. You know, we are way down below the trend lines. No one is buying a new home anytime soon. Existing homes are really slow. Doesn't mean that the business is not going to continue. But if you had 1,000 homes being sold, we'll probably go down to 450 to 500 homes. So probably going to have half the activity. Now, here is a caveat. I'm going to tell you straight up. You may not hear it from other people. whenever real estate goes into a decline prior to the economic recession throughout the economy, we have a very severe recession because real estate is 17% of the GDP. It's higher than defense spending. It's higher than virtually any other industry. The housing adds 17%. Just think about everybody who gets paid on it: appraisers, real estate agents, title companies, inspectors of all kinds, and then repairs. And then people buy homes and then they fill them up with things. So they buy furniture and draperies and carpeting. It really, really adds to the GDP. And I think right now the activity is the same as what it was. Actually, it's actually worse than 2010 and 2009. So, and you remember what happened in 2009, 2010? We're going to talk about that in just a second, because I think we have major problems coming, and we all need to prepare for that. Now, I went through 2008, 2009, 2010. I didn't have any problems at all. Those people that got hurt in 2008, 2009, 2010, over leveraged. So it was never the real estate asset that took the investor down. It was the debt on the leverage, on the asset. And I'm going to tell you, we are up to our eyeballs all across the globe in debt. This debt's probably going to be expunged. We're going to have lots of defaults. So it's going to be really interesting. 12 to 18 months in front of us. It's going to be historic, of course. So you just need to make sure that you get yourself out of debt, get that debt out of control, and get a big cash reserve, because we are going to make a lot of money. I'm going to tell you, we are just going to make a ton of dough in 12 to 18 months. So in 12 to 18 months goes by pretty quick. So we just need to protect ourselves, and then we're going to make some money. But in the meantime, we are going to have some interesting times. And there's going to be a lot of people. There's going to be a lot of home builders going out of town, out of business. You're going to have a lot of lenders going out of business. You're going to have probably some big banks. Swiss Credit Suisse is already in trouble. We just had the Bitcoin problem, not a Bitcoin, but a cryptocurrency going bad. I think that'll be followed up by a lot of people who probably invested in them. I'm told like $1 trillion went away. That's a lot of money. So that is deflation. So when you lose values, that's deflation. So the economy is deflating. People forget about that. So we're heading into a deflationary period here. It's going to be kind of interesting. Let me go to my very next slide, and let's just take a look at that. Now, here's what I'm talking about. Now, I've been in business for almost 50 years. I started in 1972. I started part-time, and I was full-time by 1974. 1973, 74, of course, with terrible recessions. I didn't know any better. I made a lot of money. So people kept telling me how bad it was. I didn't know any better. So that's going to be what's going to happen now. But in 2007, the market was done. And we've talked about my models. Now, I'm going to be talking to Charles Nenner next week, and we'll schedule something up, and we'll have another conversation with one of the world's leading cycle researchers. But in the meantime, we'll talk about my model and what happened in 2007 and 2008 and how that relates to today. We're also looking very, very similar to a 1980 through 82 period. It looks very, very similar to it. Rising interest. We had a huge inflationary period. I worked through that. So I remember this distinctly. So we had a lot of inflation going on. We had lots of interest rates coming in. Paul Volcker was just relentless with his interest rates, and it just really just brought the economy to its knees. Just dropped dramatically, and people were hurt. Just hurt. So I think that's what's coming to us. But let's just talk about, because I think the cycle is completing, and we're going to talk about that in just a second here. Let me go back to this slide so we can talk about the cycle completion. Now, I'm using this Federal Reserve electronic database for Phoenix. Now, Phoenix was the poster child for bad business investment during the housing bubble of 2004, 5, and 6. Now, right here, I'm going to tell you in Q4 of 2005, we stopped going up. Now, I know that this continues going up to this final peak. But really, when you look at these and we get them down into crunching numbers, so it would be very boring for us to show you what's really going on. This is a much better graph so that you can see it's a lot more visual. By week time we got to Q4, we were done. The economy was done. Everyone who was going to buy basically bought. This was one heck of a ride. Look at this. So look at this. Look at the way this went up in 2005. Now here in Phoenix, Arizona, it went up 54% in 2005. That's pretty historic. In the last couple of years, we've had 50% increase. I think we're going to give a lot of that increase back. But this is where we're at. Now, what happened was that everyone was done buying, but then the economy was still kind of moving along, and we got going towards the second peak. The second peak is just slightly higher than the first peak, but all the momentum's gone. So you get through here, there's no one really buying and selling. There's a little bit going on, and they are at slightly higher prices. This is like they call the fool's area. So this is kind of like the winner's curse, I've heard it called as well, is if you buy through here, you're probably going to lose money. And that's because when the cycle completes, when it starts coming on this other side, the prices come down. So when you think about what's going on now, we've got here in Phoenix, Arizona, we've got prices that have dropped 15 to 20%. I've seen stuff that's even more than that. So even though interest rates are going up, had you bought in the last month or 2 months, you would be underwater. So if you'd have bought, even if you paid like 3 or 4%, the house wouldn't be worth what you paid for it. That's a very bad thing to do. Now, if you're a long-term investor like most of us, that's not going to bother us whatsoever. So I'll tell you personal that in 2008, when things were really, really bad, it didn't affect me at all because rents continued to come in. We had no intention of selling any of our portfolio. All we were doing is collecting our rents. The rents paid for all our bills, and our life went on. We just had a great, wonderful time. It was no problem whatsoever. So I'm going to suggest this is probably what's going to happen for most major investors. We're just going to be clipping coupons for the next couple of years. Go on vacation, forget that you have this, and in a couple of years, we're going to make a lot of money, and we're going to come back. But those that are over leveraged, so if you expected to buy the house and get $5,000 a month rental because your mortgage costs you $5,000 a month, and maybe overpaid for it a little bit, being exuberant, because there's a lot of exuberance. Remember, we have a buy protocol, and that buy protocol is very, very strict. It's got to be economically valid. If it's not economically valid, we are not going to buy the property. That's just not going to happen. So we react to this. So we're looking with our investors. We think that things are going to slow down, and we'll just be very inactive. Now, there's always deals in the marketplace. There's always things worth buying. Good properties always sell. So it's always, sometimes you see an extraordinary property, go ahead and buy it because things will get better. But if you need to flip these things and you need to get more than what the property is worth to make it economically viable, it's not something that you want to buy. I mean, that was always the case even in the last couple of years, although people didn't realize that. They were exuberant. But if it's not economically viable, we are not going to buy it. And I think we're going to see some pretty tough times sledding here in the next little bit of time. So let me go back to these charts. Now, when we come through 2005, this is the very first peak. This is the second peak. That is the top. And that was right around, 2006. Actually, if we got down, it would be like, first, second quarter of 2006. This is not exact because these are regional. So when we talk about a national bubble, each region just is a little bit different because they're a regional real estate industry. And then it started to decline. And in 2004, it was over. We were done. The cycle completed in 2005 through 2008. And then it's went into the first quarter of 2008, and we had a waterfall event. So we had a huge acceleration here in 2005. We had a huge deceleration here in 2008. Keep in mind, now you see where this ended up was still higher than what it was in 2005. We just had a bubble in here, but it still was higher. So it was still still good value. We just wanted to make sure that we got our asset was always protected because this was brutal. Lots of people losing money. Had you bought up here, you would have lost, you'd been underwater, and that is not a very good thing to be. Now, if you've got a 20-year horizon, it's not going to make any difference to you at all. However, a lot of people got very, very scared with that. Understandably, we had lots of particularly first-time home buyers. They got involved with this. They didn't have any experience with it, overpaid for it. Now that wasn't the case in Phoenix this time because we had an awful lot of institutional buying going on. So there's an awful lot of first-time home buyers waiting in the wings. I think they're going to do exceptionally well because they didn't buy, and the institutions paid cash. So even though if the properties go down in value, they still have the cash flow coming in. So probably the impact is going to be far less in this completion of the cycle than it was in the other completions. Still going to be brutal. Still not going to be a lot of people going to get hurt, but I don't see this where we're going to need to jump off a bridge or something. So let me just go back. Let me go to my next cycle here. Now this is my stylized version. Again, we do algorithms, we do calculations, and we put this together because it's much easier. Otherwise, you're just going to be seeing these squiggles, and sometimes they're a little hard to follow. I think that we are here. I think we're getting here. I think this is oftentimes, if you look, this is called the winner's curse because obviously, if you're buying here, we've got a completion coming, and this is not a really good place for you to be, particularly if you're going to overpay for a property. So we're very careful what we're buying. We want to make sure that there's a very good reason to buy this. It's an economically viable property. Otherwise, we are certainly not going to buy it. So I think we are very close to this. Now, I think we're not going to see anything till probably next year, where I think we will see some decreases in prices. We're already seeing a little bit of it here. But if we go back to this last cycle, remember, we saw a little bit of here. Is that I think we're here where you're still going to see some home prices going up. Things are going to look like they're getting better. People are going to feel, oh, well, not so bad. Prices are going to, so the delta, the rate of change, the acceleration of the appreciation is slowing. So still appreciating, but the rate of change is really dropping. And people think, well, this is still fine. And it sucks a lot of people in. So when you get to the top, the rate of change has changed. So now instead of it accelerating, it's starting to decelerate. And when you get over here, we start to get a rate of change on a deceleration that's pretty significant. But this may yet be another 6 to 12 months before we really get this. Then I think we're going to get deceleration. And really, not every one of these cycles is just a little bit different. So you can't say that this was going to be exact picture perfect on the other ones. All I can tell you is I think we are cycle completing. It's going to take a little bit. We're up at the top. It's a process. It's not a point. It doesn't say, oh, this is the top, and we're going to go from there. Because what happens is it starts, and it's unrecognizable at the time because it's very gradual with the gradual change, and that's where we're at with that. We're gradually changing to a declining market. Now, look at this here. I think this is really good. I got this from Zero Hedge the other day. I've seen this before, and this is really talking about the stock market, and of course, virtually any market really can do this. But this looks really very similar to mine as well, because this is talking about rate of change as they're going up here. This is accelerating pretty doggone dramatically. And I would say this was probably 6 months ago we hit that peak. So this would have been like, March of 2022 was probably right here. If we're going to call a peak, I would say this is March 2022. And of course, the rate of change has started to slow. We've seen prices come down, and I think we're probably somewhere between here and here. Is that we've got the rate of change has stopped, and so this was a negative rate of change. So I think that's kind of slowed down because this was probably a 15 to 20% on some of these properties change in price. Now, again, it's a little confusing when you talk real estate assets because oftentimes there's an asking price, and an asking price could be way over what the reality of the purchase is. So if you're going to buy the property at 100,000, but you ask it 125, and you come down to 100 where it's worth, Well, you say you lost 25%. Well, no, actually you didn't, because it was always only worth $100,000. And what happened here is this is 100,000, this is dropped, and now it's worth $80,000. So this is really what's happened, and that rate of change has dropped. And I think we've probably stabilized for the moment, and then we're going to start heading back up a little bit, but very, very nominal. This will be a very, very nominal increase on property price. You're going to see a lot fewer properties being sold, so the momentum of the volume is really gone. There's no momentum to purchase these properties. And of course, once you're done, when everybody is bought, that's the cycle completion. Now, this will probably be late 2023 before this happens. But then I think we're going to have a waterfall event. Now, how steep a waterfall event, I'm not quite sure, but I think it's certainly going to come. So we have had demand destruction. There's no ifs, ands, or buts about it. It's certainly there. We had Paul Volcker, of course, not Paul Volcker, but our Federal Reserve is certainly being very, very aggressive, and they're going to keep raising interest rates. And we are certainly getting to demand destruction. This is going to be very difficult for my industry. Builders, I think, will be very, very aggressive in trying to get rid of their portfolio if they have. And I think virtually across the entire economy, we are going to have some significant pain coming. And there's no avoiding it. It's just the fact that you just need to know that it's coming, and you need to take advantage of that. So what I would say is, let's get out of debt, start saving more money, be very, very cautious with any purchase. This is probably not the time to be buying a new car, new furniture, new appliances, unless you need them. If you're going to make that purchase, then make sure that you can make a very good one. I think that the retailers are going to be very, very aggressive in getting rid of their inventory. So probably some really, really good buys coming. So I would certainly think that that's worth looking at. But I would be judicious in putting any more debt on. I'd make sure my credit cards were as clean as they possibly could, and keep my credit very, very good, because I think we've got some real opportunities coming to us. It'll take a little bit, but you are going to make a lot of money. So what does this really mean for you and I? What does this mean for us? Well, I think it means that we need to be very, very careful, judicious in our debt, careful with our credit. But I think a huge opportunity is coming. I think just an enormous opportunity. What will happen? Let me just see if I can slide back up to these. Right here. When you get down to this one here, you can almost buy with impunity, because this is bottom. And I think it's probably going to bottom, if it goes down to from 100 down to, 70 or 75, and then it eventually goes down to like 72 or 73. Anywhere in this project, you are going to do really well, because the next leg will start, which is like down here. So it's going to start going up again. And this is a buying opportunity of a lifetime. Honestly, you get one or two in your life. This is coming to you. This is a huge buying opportunity. However, you got to keep your credit good. You got to maintain your capital. You got to make sure that you've got income coming in so that you can afford a property. So if you're a first-time home buyer, you've got the world coming to you. You're going to make a lot of dough on this. This is going to be a great, great time. And a lot of first-time home buyers were out of the marketplace because all the institutions were buying. So even though you thought they were doing you a disservice, they actually did you a terrific service. So keep your job. Make sure you do really, really well. Be very careful with your credit. And I think you're going to make a lot of money. I think that you've got one of the greatest opportunities of your life coming. I could be here quite yet. Stay tuned. We'll tell you when it's time to buy, but you will make a fortune. So this is what we do. We make money for people. We preserve wealth. We make sure we have plenty of income coming in, because it's what's necessary. It's not how much you are worth. It's how much income do you have coming in each and every month for you to live on. That's what we do. If you need to reach me, I'm at michael@michaeldouville.com. And of course, we are licensed through West USA Realty. They keep us in compliance. My very, very best to you. If I can help in any way, please let me know. My very best to you. Bye-bye now.